Right now, US stocks are paying investors less than risk-free Treasury bonds. Not in theory, not in some obscure academic model, but in real observable market data. What you're looking, when you take a look at this chart, what you're seeing is one of the most important and most ignored signals in all of finance. The US equity risk premium has turned negative. That means that investors are taking equity risk, on earnings uncertainties, drawdown, valuation compression, geopolitical risk, and are being compensated less than if they simply bought treasuries and did nothing. Historically, this does not end well, and yet this is happening while markets are near all-time high, volatility is suppressed, and investors' confidence remains elevated. So that's a disconnect in this story today. Now, what is this equity risk premium? Let me explain to you, because essentially, my Patreon channel, I'm here to not to tell you, how to quote unquote make money and pick this stock and that stock. I'm here to educate you so that you understand what's happening, and I'll do it to my channel as well, but more directly to my Patreon. But in any way, the equity risk premium is simply the earning yields of the S&P 500 minus a 10-year Treasury yield. So basically, it's a P ratio, but instead of being price to earning, it's earnings to price. How much earnings are you generating for each stock that you're buying? It answers a fundamental question. What should I own stocks instead of risk-free bonds, right? I mean, the risk-free bonds, you know exactly how much you're getting paid because the bond doesn't change the dollar value, and you know that you're getting the money from the government and it's guaranteed. So if you're going to take risk, you got to pay more than that. So historically, equities compensate investors with a positive premium, often 3 to 5% to justify the volatility and the uncertainty. So technically, what we should be looking at is, as you could see, basis points, which is basically percentage, 5%, 6%, 7% sometimes, right? In the 2000, 2005, 2009. You're not getting paid that anymore. So what is this chart telling you? Look closely at this Bloomberg chart. Every major spike in the equity risk premium corresponds to panic. The 2008 financial crisis, right, on the left. The Eurozone stress, the COVID shock, you see, 2020, that little spike. Why? Well, because if you're going to invest in stocks, you want to get paid for it because of the risk. But so, and every time these spikes occurred when prices collapsed, yield fell, and earning expectation reset lower. Those were buying opportunities. But what happens when the line goes below zero? That only occurs when equity valuations are stretched, meaning you keep bidding up the price, right? But you're not earning. Essentially, when there's a black swan event, yes, that's when you buy, right? But you want to be there before the black swan event. Well, if you want to be short, yes. Otherwise, you wait for the black swan, then you buy. But when is the next black swan event? That's the question. But here we have some kind of justification. Those were buying opportunities. But what happens when the line goes below zero? That only occurs when equity valuations are stretched, bond yields are high. Currently bonds are high. The yields of bonds are more than 4%. The reason the yields are more than 4% is because the traders expect more inflation. So they want to be paid to hold treasuries. Earnings expectation are optimistic and risk perception is suppressed. We don't care about the risk. Keep bidding up the price. Right? For the same earnings, you want more. Historically, this configuration appears near market tops, not the bottoms. So why is this time not different. Well, every cycle has its justification. Today's justification include AI productivity miracles, soft landings, rate cuts right around the corner, permanent earnings growth. But markets do not price narratives. They price cash flow discounted by the yield. You need to pay more attention to the credit markets. When bond yields rise faster than earning yields, valuation math breaks. No amount of storytelling changes that. The equity market is currently priced as if earnings will go on uninterrupted, rates will fall soon, and volatility will remain contained. That is an extremely fragile equilibrium. Yes, I know it is an equilibrium, but it is very fragile. The Fed, the rates, and the valuation traps, this is the uncomfortable truth. High rates don't just compete with stocks. They reprice them. The market is discovering that higher for longer rates compress multiples, earnings growth alone is insufficient, and buybacks slow when debt costs rise. That is why equity risk premium matter now more than ever. And not many people are looking at it because they don't really understand it. They're looking at the stock market. You need to look at the stock market and the credit markets together. They are the bridge between monetary policy and asset prices. When that bridge collapses, markets don't glide lower. They reprice violently. One of the most dangerous features of this market is passive concentration. Index funds buy regardless of valuation, allocate capital to the largest companies, and reinforce momentum until it breaks. This artificially suppresses volatility and inflates multiples. But when risk premiums turn negative, the passive flows become accelerant on the downside, not stabilizers. This is now valuation-based buyer underneath. At the end of the day, the people are saying, listen, I'm getting risk-free rate and I'm getting paid more than your stock. Why would I even think of holding stocks? Technically, the rate should be going down. Let's be precise. Negative equity risk premiums have historically resolved through equity price declines. That's what we have right now. We have a negative equity risk premium. So they've been historically resolved through equity price declines. The stock market goes down, earnings downgrade, rising volatility, and falling bond yields after economic stress. But notice as that does not resolve, it's sideways market, grinding higher forever, and valuation staying elevated. Market must restore a positive momentum. Premium, they always do. The only question is how painful the path is. So what is smart capital doing now? Well, institutional investors are not blind to this, right? If I'm telling you this, these guys know it. The institutional investors, the pension funds, the insurance funds, right? They are reducing equity beta, buying low beta stocks, increasing duration, rotating towards real assets, i.e. gold and silver. That's what you're seeing. And they're holding their dry powder. That's why it's a good idea to wait with your cash on the sideline for the decline. But retail is still chasing performance. I want to make some money. The market is going up. Are you going to make money because the market is going to keep going up under any circumstances? That divergence usually precedes regime change. So final warning. Let me leave you with this. When stocks pay you less than bonds, you are not being rewarded for the risk. You are subsidizing it. I'm not saying panic. I'm saying discipline. Markets don't crash because of fear. Markets crash because risk was mispriced for far too long. And right now, risk is being priced at zero.